extensions that we've witnessed, I would say, in comparison to 2007 and then even into before that, the tech bubble, because we have a number of forces inside of our markets that are all working really uh, against the market. And one of the big misconceptions I think about this rally is that it's somehow tied to forward expectations of some kind. This is purely a short covering rally. It is a hedge covering rally. We have hedges on the run up into our previous all-time highs, which we're 25 points away from, by the way. And the VIX is falling back down into a long from lows, from its old contract lows to new contract highs. I'm going to do a little sidetrack here and look at the VIX from the perspective of its now continuous contract. This is the new May contract included in the continuous contract price. Now, it is still inside of extensions, but from its old contract April lows to its May contract highs, we have this little pullback that we're inside of. And the markets, the indices, can rally as the VIX falls back down into the support. That would be a 1950 down there. Now, that's the continuous contract. What takes us back down into those levels is the series of extensions that we've been inside of, and nothing has broken on the VIX. The VIX's individual April contract is still inside of extension shorts from last week Friday's lows to lows. And there's where that 1950 is down there. So, over the longer term, we have the dollar strength cycle. This is the 4-year credit cycle. We are still in a massive dollar pullback. Short term, dollar weakness. Longer term, dollar strength. We still have that massive headwind. We have the Fed rate cut lag. And that in this window, we typically have 22.2% declines, starting all the way back into the 1940s. We have a war in Iran. I think we have 7 days now until the ceasefire is officially over. Islamabad 2.0 has not even been scheduled. So, the energy, crude oil prices are still inside of shorts intraday right now. We're going to be paying attention to these VIX shorts and crude oil shorts. And as they fall back down into their support levels, it's going to be probably one of the most important times to be understanding what's going on in price. I would say, again, referring back to the 2000 tech bubble and the 2008 financial crisis, because when we break these extensions, and eventually we will, we are going to go back into people understanding those narratives to add to the AI creating a deflationary type of environment, and all that's left is really a trend break to go from having those hedges on the run, squeezing back up into resistance, back to, well, everyone now is exposed to the long side of the market. And are all of the issues that we and they had initially hedged into before we hit our profit targets within a couple points, are they over? And the answer, of course, is no. So we have this stair step down, elevator up, hedge covering squeeze. And then the question then becomes, how far can we squeeze this thing, and where do the extensions fail? And if and when the extensions fail, this stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.